All right. Good morning, everybody. It's new week and very soon a new quarter. China still continues its surge with continued stimulus. They're throwing everything at it that they can throw. A lot of things are down this morning. Kind of go through the list. It's considerable. We did break the Globex range, which put us into the liquidity gap. It worked exactly like it should. But if we were looking for a micro double bottom bear trap, then we would have expected this to V and pop right back up again, much like it did back here when we had another micro bottom bear trap, right? When you get to the low, you break the previous low and convince the bears that we're going down so that they get in, then you spring the trap. They have to buy, which adds to the buying, which gets this very fruitful reversal and pop back up. When you don't get that reversal and that spring back up, then kind of implies that it wasn't much of a trap after all. Either we didn't really convince the bears to get in, or we're not going to get that follow through, that they're not selling it off yet, but we're not bouncing back yet either. So this didn't follow through the way we would expect it to, which kind of implies that this isn't a double bottom, that maybe it's perhaps an upside down cup, and that we may or may not get a handle on that cup, and then we continue the move to the downside. There is a bigger zone. If we look last week on the 26th, we have that low. So if we break that, we got a liquidity zone, and we did break it, got into it just barely. It's very likely that we don't have that we haven't taken all that liquidity off the table yet. So if we go back down, we can expect more attempts to hold this thing up. Should see it in the dome, the active participants, trade imbalance, cumulative delta. Beyond that, the next low is from the 25th. That'd be last Wednesday. Then the 10-day moving average, the volatility trigger, and the ADR half. 57.50 on the ES. Any move to the upside at this point has 57.92 cog line. VWAP, the halfback of yesterday, and then the call wall, and 58.11 round number, 5800 round number, 58.11 cog line, and the ADR half to the upside. We're not down very much in the ES, but the small caps are down 0.5% or more. I was going through the checklist this morning on things that were up or down, and there wasn't a whole lot that was up. VIX was up. Pot stocks, China ADRs. Now it's Monday, and I would rather have a gap down than a gap up on a Monday, especially after the kind of run that we've already had, right? This three week boost where we've crossed back above the 20 period and the 10 period moving average on the weekly. And then we broke out of this zone and took off after 3 weeks of that kind of move. If we're going to continue to hold the line and go higher, I would much rather gap down this morning than gap up. A gap up from these highs would kind of imply an exhaustion gap, and that would be more negative than anything else. If we throw a line on it on this really big bar from 9.2, we can see that the continuation moved up into 1.5. So it's just our basic measured move. We've got there, we've ran into it. And we could see the wicks across the top of these two weekly candles showing that when we got above 58, or even got to the 58, that there's just a lot of sellers up here. We don't know if that's done yet, but looking at the current week's wick kind of implies the selling isn't done, that there's still a lot of sellers up there. Put it on a daily and we kind of see that a little cleaner. Now, since we're on a daily, we've got a different big bar to focus on. This is from the 19th. You see we got into the 1, 2, 3, 6. We wasn't able to maintain that, slammed back down. We got above 5,800 or 5,811. It got into all that liquidity up there. So that's the issue. All of that liquidity, whether or not we've taken it off the board, very unlikely. And or if we run back up into that zone, are they going to back it up, right? Why sell at 58.20 if you could sell at 58.40? We're going to get a lot of data out of Europe this morning. Christine Lagarde's going to be chipping teeth, which makes the European close more important. That'd be 11:30. But we've also got U.S. Fed members speaking. And this is a lot about sentiment, right? If they're just chipping teeth, they're not making policy, they're not making statements about upcoming actions, and they're just presenting their purview, then it can radically alter the market's perception of how good are we right now. That warm, fuzzy feeling sort of adjustment. So we want to look for any signals that imply more risk-off behavior, such as Bitcoin going down and crude, semiconductors. All of those are down this morning, by the way. If you are thinking about a carry trade or any sort of swing trade overnight, keep in mind we're going to get a lot of data out of Japan tonight. So between tonight's close and tomorrow's open, if you're swing trading options, just keep in mind you may not like the outcome. We do have auctions today as well. It doesn't show auctions on all three time frames, so just assume if you have it on one that you will also have it on the others. That's 11, 11:30, 1 o'clock. We got Powell today too. This is not a policy statement, so he can still move markets, make no mistake about that, but this isn't like an FOMC meeting or something. Going to be a busy day. Going to continue to get hit all day. All right, we're slightly closer to the lower ADR than we are the upper ADR, but there's not a lot of edge to that one way or the other. If we come in the morning and we're really close to one side or the other, then we have more edge, and we can really lean into the idea that if we're probably going to hit that ADR. But we're only down 0.25%. We're not, exaggeratedly closer to one side than the other. Having said that, we haven't seen any real follow through in a while, right? Everything just keeps giving us a really good run and then giving it all back. right? We get another kind of breakout run and give it all back. And this range really has been sideways for a while. All the way back to FOMC and the day after that, Thursday after FOMC. All of this is still inside of that Thursday's range. So with that in mind, we want to keep an eye on those weekly levels. I changed the button over the weekend for a reason, but I didn't change it back. $57.32 cog line lines us up with 2 Fridays ago, the low of the day. We can see Thursday's high was the week's high of that week. And then Wednesday's low is really close to the low that we would focus on. So that gives us some pretty good structure right there. Then I would focus on last Wednesday into Thursday, that really big bar for the daily, and do the same thing, mark it out same way. The idea is if we begin to break down, we've got the levels, right? Doesn't really matter which direction price goes. We've got levels to play it. The central pivot is bearish this morning. It's below Friday's level, and price opened below the pivot, which is another bearish check mark. Price is also below the weekly pivot point, and that's another negative check mark. The channel is a little wider this morning than it was Thursday and Friday, but it's still a significantly narrow channel, all things considered. So we're back in last week's profile. We just cut through the point of control, but now that we're there, it has a relatively wide zone or channel around it. 57.70 is the level that we have to get through to get outside of that channel. Now that we're this close, we could do what we did when we were building the channel, and we could just cross back and forth in this zone. So if we can get below 57.70, we begin to drop into this air pocket, and that can take us down to 5,700 really fast. It's only 75 points, so not that big a deal, right? About a 1.5%, right? Some napkin math. 1.25-ish. Add the quarter that we've already got, that would be our 1.5. That needs to be more than just a speed bump. So when we get there, we want to see very clear market dynamics showing defense that they're stepping in and trying to hold that line. Otherwise, we've got another very large drop into 55.50. Volume's fine this morning, sitting in the 70s. Shows the participation in the overnight was pretty normal. Nothing stands out there. 10-day, 30-minute volume profile. We're back to the point of control here, and it's the same thing. Now that we're here, we could chop around this zone. This profile is just a little different than the other one. The other one is for the week. This is a 10-day profile, and it has the TPO on it. So we don't just see the volume, we see the trades as well. Air pocket's still there. If we break that, say 5750, then we can drop down into that 5700 pretty quick. We're not going to see this point of control move anytime soon. And if we do, it's going to be a significant red flag showing up, because it would take a massive amount of volume to move this point of control. And we don't have any candidate of where it could show up other than where it is right now. That is an entire week that we stayed sideways building up liquidity there. If we move it in a single day, that's a lot of volume, yeah. No VPOC from Friday. We've already cut through that level. So we don't have anything to carry forward. The profile this morning shows that aggression from last night when we popped up and hit a ceiling and just came right back in again. A little bit of defense down here at these lows. Looks like we're ready to expand from here. So we talked about the range last week and how this range isn't set in stone during the morning briefing. We have to wait for the market to close. So Friday came and went. We can now measure the range. And on Friday, the range was a little smaller, kind of implied that this week would have a little less volatility in it than last week. That's what it looked like Friday morning. Now here we are Monday morning, and that range is bigger. So there's more volatility being priced into this week's move than there was last week's move. We can make the entire move for the week in a single day, by the way. This is how far we're supposed to move on the week. There's an 80% chance that we close inside this range for the ES. 70% chance if you use this indicator on anything else. But the ES has a history of making the entire move in a single day, even though that's the week's range. We're still more than 2.25% above the 10-week. That's a good spot to be in if we're considering, a strong, healthy market. 2.25 above the 10-week is a good spot to be. We are on the decline, which is okay. We don't want to get too far ahead of our skis. So a little bit of a fade back, no problem. We're still above 2. If we get below that, we got to start thinking about, retrace levels. And maybe the 10 beginning to act a bit like a magnet. As for the 10-day, we're still 0.25% above the 10-day. We are on the decline, working our way back to it. This is a nice reset, right? When you get a breakout and a run, maybe you get a little too far ahead, need to back up, get a correction. When it comes to these corrections, we can either stay sideways and let the market heal and let price come up and meet us, or we can retrace and heal that way. Seems like we're getting a little bit of both with that weakness on Friday and then a continued weakness today. So we're pulling back a little bit, but at the same time, we've been sideways, mostly staying inside of that large Thursday range, that 919. And so we're just giving the market time to heal and let that 10 come up to us. We think about a capital rotation in the market. It's been the dominant question. You know, are we going to flip back into semis and consumer discretionary communications technology, or are we going to see more of a broadening out, more healthcare, utilities, staples, industrials, building materials? When we look at the 5-day change on this, the bottom three are defensive risk off. The middle three is kind of the midline sectors, can go either way. And the top three are the risk on, kind of the bullish sectors, or offensive, I guess would be another way to say it. So financials still weak. We set that lower high. Now we're in between this peak and that. We need to see, are we going to set a higher high, or are we going to come down and set a lower low? If we get a new high, then this will make that pivot point right there a higher low, and market dynamics are still going to be good. This is a topping pattern, not yet a complex topping pattern. Consumer discretionary continues to just expand violently, everything within its measured move. Energy still a grind to the downside. So we're not seeing a clean, clear rotation. It's a bit of a mixed bag out there. Staples basically flat over the last week, really tight zone. I don't have the squeeze indicator on here, but that's tight. That's a very tight IX10 tight range. It's worth keeping an eye on staples. And I know they're not normally a big mover, but if today's going to be a sideways day in the indexes, or, you know, a sideways day in a lot of the market, I would look at something like that that may be in a bit of a squeeze, ready to pop. Building materials up 2.6. It's had a nice run. Might be ready to take a bit of a breather. So Bitcoin's down. The Mag 7, semiconductors, gold, precious metals, technology, uranium, all those down. When we look at what's up, China ADRs, China itself, and yeah, that's what we got. Now, that's what we got on Thinkorswim, but take it over to TrendSpider, the list that I got over there. Bitcoin, semiconductors, crude, then precious metals, IWM, so small caps are down. The NASDAQ's not down enough. I want that 0.5% negative to count for that. And things that are up, got the China group, VIX, pot stocks. So last week I talked about rebuilding my watch list, or my morning scan. What this scan is doing is it's looking at the two indexes, the S&P or the NASDAQ, and it's asking how many names in the S&P are up at least 0.5%, or how many are down at least 0.5%. A lot of times you don't get a really good answer. You get this kind of 60-40, 70-30 kind of thing. Every once in a while, it's one of those days, and you'll see 85 to 90% of everything in that basket all up or all down. Those are the days that we really want to pay particular attention to these scanners. So I don't try to go in here and read the tea leaves, so to speak, and try to get something out of it that isn't there. Just keep it broad strokes, nice and simple. This is the negative one. So S&P 500, how many names are down at least 0.5% in the pre-market? 56 names. Now that's 56 out of 500. So it's not really giving us all that much, right? I'd rather use the S&P 100, but I was in a crunch this morning, so I just used the 5. May adjust it. If we do look at the NASDAQ 100, how many names are down at least 0.5% in the pre-market? 28. Well, there's only 100. So you're talking about 20, 1/4%, quarter of all the names. So, okay, that's not bad. What do we got on the positive side? 18 names in the S&P 500 are up at least 0.5%. That's not overly bullish, just like the other side wasn't overly bearish. So same thing with the NASDAQ. 2 names, Apple and PDD, are up more than 0.5% in the NASDAQ 100. Now, I used to run this scan every morning until their changes on the platform killed my scanner and got it rebuilt. There's nothing here this morning. That's the point. And that's as easy as it should be, right? That we don't need to spend a lot of time, don't need to read a bunch of books, don't have to get out the Ouija board trying to figure out what we're going to do with all this data. Just simple and sweet. How many names are up at least 0.5%? Now we've got the sectors that we look at every morning. That would point us in the direction of particular groups. This is just the broad outline without looking at what group they belong to other than what index do they exist in. Looking at it another way, S&P 500, set it on the market cap. I like to run the filter on that market cap. So instead of looking at 500 names, try to dial it down. 109 seems to be pretty close. If it's not that, then I usually catch it around 90. It doesn't matter, right? If it's really just the first 10 and then everything else. Since it's by market cap, you can see the size of the box projects the market cap. You can see the Mag 7 really easy. To get rid of a lot of this gray, the gray is because they haven't moved at least 0.5%. Well, that's my benchmark, right? In the morning, have they moved at least 0.5%? Before I adjust anything, that's what we're seeing. Anything red and green meets that criteria, but everything else doesn't. In this view, you can see we're more negative than positive, but it's not overly negative. And we can see that semiconductors are really getting the beat down. Now we can make the adjustment. We got a clearer idea of things that are up or down without using that 0.5% as a benchmark. So this morning, watch the clock, keep your eye on the news. If we're going to see things change, it's going to have to be from either we get a 0-day play, and those are hard to spot because you won't see it in the breadth, right? You won't see, 90 names in the S&P 100 all running up or down. So you won't catch breadth if it's a 0-day. It'll be options flows in the Qs and SPY and SPX, ES. If we make a rally and it's not because of the 0 days, then where's the rally coming from? That could be news, right? We can get some data from Christine Lagarde. Maybe she says something the markets like or don't like, or Powell says something, and that can move us. That also will happen without breadth. So you won't see it in how many names are running, not right away. it would have to expand first. If it's not news and it's not a 0-day, then you should see it in breadth. You should start to see more names up than down, and that they continue to expand the number of names that are up and down, increasing, and then how far. I use that 0.5% because we're doing the briefing at 7:30 in the morning. If you're doing this closer to the open, or even if you're doing it in the middle of the day, your benchmark should be higher than my 0.5%. Do it at least 1%. How many names are up and how many names are down by at least 1%? We called a sideways day most of the week last week. Almost every day it was like Groundhog Day over and over. Same thing. We're going to hold the line, waiting on data, hold the line, waiting on data. Well, it's a new week, and I think the mantra is going to change a little bit. We've got our range defined. Whether or not we're going to hold it is something that we're going to find out. So I'd say let's test the edge of this range and see how markets react, what kind of liquidity we have around that 10-day moving average. And then we'll reassess whether or not we're going to hold the range. We're already inside day breakout. We're outside of Friday's range. So from that point of view, we didn't hold the range. We're already out of it. And we didn't V bottom up off of it either. So this wasn't a micro double bottom bear trap that triggers us back up, into like 57.90. It didn't happen, so it isn't one. That implies we still got room to the downside. Base case argument today is that we test that ADR, 57.50 on the ES, which would be a measured move from Thursday of 50%. Right there. That's my base case argument for today. Now, if we do flip and we can get through the halfback, then we can always do the other side. So if you want the alternate thesis, if we can get back through the half, then we can go to the upper ADR and we can challenge Friday's high for an inside day breakout on the other side. Make no mistake about it, that is on the table, right? This isn't an either or proposition. We can break out of Friday's low and then turn around and run all the way up, and we can break out of Friday's high. No problem. If we get through this liquidity zone down here, then I'm going to continue to aim for the 10-day. But that is the next level that we have to get through to even consider a move down to that 10-day. So whichever way it goes, doesn't matter to me. We got a direction. On the pullback here that we're expecting, if we look at the bigger move here, Thursday's high, Thursday's low. This is the zone. That would be the 786 that we would have to get through. Think about it another way. We're basically asking, if it's a dead cat bounce, how high is the bounce, right? You got a market that sets that high, falls, and now it's pulling back. How high does it have to bounce for it not to do that? And that would be the 786 level. So it needs to get above that 786. Otherwise, we're much more likely to break that low and continue lower. $57.92 cog line lines up really well for that 786. And it's not a perfect line in the sand either. Remember, price doesn't see our drawings. It doesn't care what we drew. We're performing an analysis on, if there is a bounce, how high does it have to bounce for it no longer to be considered just a dead cat bounce? If we zoom all of this in and only focus on the Globex, then everything gets a lot tighter. There's your 786. $57.84, which lines us up really well, these levels back here. That was the 8 o'clock candle with all that violence. That really big bar. I know it's hard to see because there's almost no candle there. But that is the 786 level that we would have to get through. We can tighten that up even more. And we can do just the last run. Draw it in the other direction though. $57.79 for just that run right there. It's the top of the liquidity. It is the bottom of the Globex before we broke out. Amazing how that lines up, isn't it? It really doesn't matter where you draw it from. Everything lines up as it should. So if we can get through that, we can get to VWAP. If we can get through that, we can get to the Globex high. If we can get through that, you see how it works, right? Next level, next level, next level. Hey, everybody, be careful, be safe, have a good day. I will see you all tomorrow.